Mostly for listed clients, I assume. Well, I assume it's across the board, yeah. Yeah. Because you helped out a little bit on Equestria, I remember, yeah. Yeah, exactly, yeah. Oh, really? Okay. Okay. Okay, interesting. Okay, let's get stuck in. Okay, so we're going to talk a little bit about dividends and share repurchases to start. How's it, Tandani? So we're going to start off with a bit of theory around, what are dividends, what are the differences, different kinds of dividends. We run through this pretty quickly, and then we get stuck into things like differences between dividends, share repurchases, different kinds of dividends theory, things like, when should a company really be thinking about dividends? When should they really be thinking about repurchases rather? And really, is there an actual difference? And what does that mean for the business? Okay, so a little bit of theory to start. Run through this fairly quickly. Cash dividends, I assume you guys know about this, pay out cash. Okay, quite easy. Companies typically do it on a semi-annual basis. If you're in the States, they may do it on a quarterly basis. We're looking at special dividends. Maybe they sell a big business, they have a big contract that comes through, one-time special dividend, right? One of my personal favorites, liquidating dividends. So not necessarily doing so well. So how about we just kind of, close down the division or close down the business and we issue a liquidation dividend. Okay. I think everybody's comfortable with that, right? Theory, you read it once, you should be able to knock it out. Okay. Stock dividends, what are we really doing? We're kind of taking the pizza pie and we're chopping it into more pieces, right? So does this really actually mean anything? Previously, we had 4 shares in the business. Now all we're going to do is we're going to issue something like a stock dividend of 2 for 1. We're going to have 8 shares in the business, right? So we essentially just issue more shares, right? So the size of the pie or the pizza does not actually change, just the number of slices. Okay. Okay, so increase the number of shares in issue, but will ultimately reduce the share price. Okay, so no change to the actual value of the company or the market value. They go through a quick little example here. Let's touch on it together. So issued a 10% stock dividend. So before the stock dividend and after the stock dividend. So shares outstanding pre 2 million, shares outstanding post 10% stock dividend. Should have another 200,000 shares being issued. So we should see a commensurate reduction in the share price or dilution in the share price. The market cap will effectively stay the same, right? So market capitalization, the full value of the equity will stay the same. And so naturally, we'll have a dilution in the stock price. We'll also have a dilution in the earnings per share. Yeah, so somebody's equity stake ultimately will inevitably stay the same, right? Percentage stake, if you, ownership value will stay the same. Right? There should be no economic change in the business whenever you do a stock dividend. Okay. The other side of a stock dividend is stock split, which you can do instead of actually, sorry, it's not the other side, it's effectively the same thing. Essentially, some companies believe that there is an optimal share price at which each company should trade. I don't know, you guys may know it a bit better than me. Berkshire Hathaway, they effectively say, like, listen, we're trading at, what is Berkshire Hathaway trading at? I thought it was about, pardon? In rands, 20 million. Yeah, I thought it was something like $300,000, I thought, US dollars. So, yeah, it'll be in the millions. So, the problem is that when your retail investors, can't get access to a Berkshire Hathaway share, so then people start copying it. So I think that's why they went to like a dual share structure. But anyway, we're getting off topic. Okay, so, pardon? Yeah, well, I think a lot of people were imitating Berkshire Hathaway and were trying to encourage retail investors to invest like in a Berkshire Hathaway or a reflection of a Berkshire Hathaway share. So, I mean, I think he wants to give people the opportunity to get the real thing as opposed to like an imitation of it. So I think that's why they went from a Berkshire A share to a Berkshire B share. Yeah, exactly. Here we are. You can consider a share become so costly that investors cannot afford to buy it. So to correct the situation, a number of companies do a stock split. So let's see here. So ultimately your earnings per share would halve. So your is what your share price. So ultimately there should be zero gain for the shareholder, right? There is no gain or loss for investors. So funnily enough, when I was in the States, AIG actually was going through its issues in like 2007, 2008, and it became a penny stock. And penny stocks do not necessarily have good reputations, so they did, I think, what we're going to talk about, a reverse stock split. So we'll talk about that now. Stock split, yep, you can see from this little example, I think fairly basic, right? So before the stock split and after the stock split, they do a 2-for-1 here, so they go from 2 million shares to 4 million shares. The stock price should halve, your earnings should also halve, your PE multiple should stay the same, price to earnings ratio stays the same at 10. There's no change in the economic value to shareholders. Okay. So they just say here, price effects. What happens to a share's price after a stock split or a stock dividend? They say that, in theory, you issue a 2-for-1 stock split or stock dividend. Ultimately, you should see a share price halve. But ultimately, what they say is that shortly after the announcement of a stock split, the share price rises. The price increases usually as a result of investors thinking that splits are a signal that earnings for the company are on the rise, rather than a desire for the stock shares or stock split. However, shortly after the announcement, the company does not announce an increase, and the share should drop back to its previous level. So they say that based on their studies, you tend to have this little spark, but then it typically comes back, trades back. Okay. Brokerage charges on lowered price shares are higher than on higher price shares, and therefore it's more costly to trade these. This could actually reduce the liquidity for the company shares. Okay. So I think that's just empirically what they've seen in the market, is that you tend to have this little bump. Reverse stock splits, AIG. AIG wasn't trading at such a good level, so they did a 2-for-1 or 1-for-2 stock split. So there will be less shares in issue. The stock price should therefore be higher. Your earnings per share should be higher, but ultimately, again, there should be no change in the economic value of the company. So, have you guys come across any companies that have done stock splits, stock dividends? I don't think it's that popular. Have you seen any, Rob? Nothing. I can't remember the last time I actually saw it. Yeah, seems like a bit of work for actually no real change. So, anyway. Financial ratio effects. So we talk about cash dividends. So the payment of cash dividends should result in a higher reduction in equity, so higher leverage, right? So I think that this is quite important for the CFA. They tend to ask you these kind of questions to make sure that do you fully understand what is the difference between a cash dividend. Clearly, a stock split or stock dividend, there's no cash being paid out. There should be no change in terms of your liquidity or equity type ratios. So if they say things like, what is the difference in terms of a cash dividend? You should anticipate equity decreasing, assets decrease, equity decreases. So ultimately, it's a bit of a leveraging effect on the balance sheet. So, okay. So we're going to talk a little bit about theories. It's called the dividend irrelevance theory. We're going to talk about one saying, I think it's called bird in the hand theory. And so when people are thinking about issuing dividends, what does it really mean? Are they thinking about, does it actually make sense? So we're going to talk again about Modigliani and Miller. They said that, your capital structure shouldn't really matter, right? There shouldn't be a difference between using equity or using debt. Assuming that there's no taxes, assuming that there's no brokerage costs, assuming that there's no financial distress, we should be really indifferent, right? Your capital structure should not govern the business. The business should really govern the value. The type of risk that you take and the returns that you earn, that should determine the business. Whether you use debt to finance it or equity to finance it, shouldn't really make a difference. So, okay, so let's dive into this. A couple theories on dividend policy, and explain the implications for each share value. Okay, so a company's objective, they say, is to maximize shareholder value. So the principle is to guide the managers to how large the dividend payout should be. Target payout ratio should be the target percentage of net income to be paid out as dividends to shareholders. So, and they say it should be based on investors' preferences. So we're going to talk about this in a little bit. So we'll talk about a clientele effect, talk about a tax effect. So if you have differences between, some people may say that, look, I'm taxed at a higher rate, so don't pay dividends. Yeah, so investors' preferences to either distribute income or to rather reinvest the income. So we look at this constant growth valuation model. So we can see that we have dividends. Essentially, we have our payout ratio on the bottom. So let's look here. So this model formulas: the larger the dividend payout, the larger the share price will be. A large payout also means that less reinvestment back into the company. Less reinvestment should mean lower growth, right? So will result in a decrease in the stock price, which I think is intuitive, that if you're paying out a lot, you have less money to reinvest. Less money to reinvest should mean lower growth. Okay. So I think the optimal dividend policy is one that seeks to try and maximize this. So between dividends paid, future growth, and therefore maximization of the company's share price. Okay. So I think that's what, it's a bit of a balancing act between paying out dividends and effectively keeping the dividends and reinvesting them into the business. Okay, so on that basis, let's talk about a few theories for dividend relevance. So what, in fact, let's open it up a little bit. What do you guys think? Seeing as we've got a fairly small class, do you like dividends? You don't like? What do you guys think? Huh? At Deloitte, what does Deloitte say? Pay dividends? Huh? Just give me the money. What do you guys think? Do you like dividends, or do you think, nah, look, Berkshire Hathaway, don't pay a dividend ever, reinvest the money into the business? You think so? Well, so you got cash, bird in the hand theory, huh? Better to have the cash. Give me the cash up front, huh? So I think that's another theory, yeah. So what signals does it say to the market, right? If you guys see somebody paying a dividend, what does that signal? Are you doing well? If you increase the dividend, is it a case of, well, maybe you just can't find any opportunities, you know? So I think that's the balance, right? That you got to be thinking about. Okay, let's look at the first one, dividend irrelevance theory. Modigliani and Miller. A company's value is not determined by its capital structure, but rather by its business risk and its earnings power, right? So they say that on this basis, the dividend policy has no effect on a company's value and its cost of capital, right? So they're saying, look, you know, your dividend policy is actually irrelevant to the company, and they say here actually, which is quite interesting, that an investor can effectively construct their own dividend, right? So if you don't pay me a dividend, then effectively the share price should rise by that value. I can just take my shares and sell a little portion of my shares in the market and effectively, you know, manufacture my own dividend. So, yeah, so, and no taxes. Yeah. So we're going to talk about this now. So I think that's the second theory, or the third theory, where we talk about you try and optimize the tax position of your clientele or of your shareholders. So the first one, dividend irrelevance theory, Modigliani and Miller, there is no difference as to whether you pay a dividend or you don't, okay? So because anybody can just manufacture their own dividend. Okay, so yeah, they just finish off here. You can manufacture your own dividend. So if the company pays too little, you can just sell stock. If the company pays too much, you can just use the excess to buy new shares in the market. So, but like you just pointed out, there's brokerage charges and taxes. So it may not necessarily, it can become relevant. Okay, your dividend policy may become relevant. So, okay, bird in the hand theory. Shane, give me the money, right? So better to company wants to try and maximize by setting a high dividend payout ratio and hence paying out a large dividend. So many people would rather receive a tangible benefit now, such as dividend, than defer that benefit until later, right? So people want certainty. They want to see cash return. So it's very nice, very good and well. you speak to somebody, they say, look, I'm actually keeping the money in the business. I'm trying to grow the business. I'm trying to do new things, take advantage of opportunities. Yeah, I mean, maybe Steinhoff was saying the same kind of thing, right? Or maybe, sorry, that's a bit aggressive. So who was Steinhoff's auditors? Were they? Okay. It wasn't Deloitte, was it? Tax preference theorem. So we want to maximize the tax the tax efficiencies. Okay, so either where dividend income is taxed at a higher percentage than capital gains, we would rather that they keep the money in the business. Okay, so we've spoken about dividend irrelevance, we talk about bird in the hand theory, and we're talking about tax preference theory. So the other thing is a capital gain is only paid when the stock is sold. So naturally you have a deferment of taxes paid, right? So I think the more you can defer taxes and rather just let those gains compound in the company, that's considered to be a better thing, right? So time value of money implies a saving for the investor. Okay. They say that I'm not sure that this is still relevant. So obviously, if the investor passes away, capital gains are not paid at all. But I think in South Africa we do other stuff. We have estate duty. So what's that? Sorry, is it the deed disposal? So do you pay capital gains at that point in time? So they say that, I mean, in this instance, they talk about a rollover of the cost base, which, yeah, I don't think it's necessarily accurate, at least not in South Africa. So on that basis, investors would prefer that companies retain the earnings rather than pay out the earnings. Okay, so yeah. So I think that this is just important. Company stock will have to appeal to certain investors. Okay, so we're going to talk about this now. I think the clientele effect. Down here. Okay, so this is back to our signaling. Remember, we spoke last time about you want to send certain signals to the market. Pecking order theory. People would rather use money that's available in the business because it sends the least amount of signal. If you send debt, typically it means that you're going to make a big profit in the future. You want to try and use as much debt as possible, right? I want to take full advantage of that big gain that's coming to me. And then I don't want to issue equity. If I issue equity, I may be considered to be overvalued, right? So I think a lot of people would rather say retained earnings first, debt second, equity third, right? Okay, so, and what is that all based on? Asymmetry of information, right? So because managers have more information, they understand the business better than shareholders, right? So, so let's see here. So investors and managers have different levels of information about the future earnings and dividends. So managers are naturally, they have better information than investors do. Investors look for signals in the company in order to gain a better understanding of what's happening within the company, particularly as to the company's future prospects. They argue that companies that do not reduce dividends generally and only increase them expect to or achieve higher earnings. Okay, so signaling to the market. So companies that increase dividends or declare higher dividend than expected is a signal to the market that they expect good future earnings. Okay. Okay, so all around signaling, because of this asymmetry of information, when we talk about dividend initiation, they say that it's a bit ambiguous. So on the one hand, you may be viewed as a positive signal. You know, you're optimistic about the future earnings. We're going to earn a lot more money. We can essentially pay greater dividends. At the same time, maybe there's no more opportunities. On the other hand, it could be viewed as a negative signal. Does not have any better investment opportunities, right? So a bit of a, I don't know, double-edged sword, I guess, when you initiate dividends. Dividend reduction, what do you guys think? Huh? Not so good. Huh? I think anybody that seems to be reducing dividends, I mean, unless you are in a global financial crisis, yeah, I don't necessarily it's seen as a poor, a signal of poor earnings in the future. Different signal based on how the management delivers to the market. I mean, like if the guys come out and say, look, we've got something down the pipeline and X, Y, Z, whatever, we're going to reduce dividend. I don't think the reaction to that is as academic as we read. Yeah, so I think it's
investing that relies on equity.
Correct.
And if you
Institutional like investors and stuff.
But if you change the signal to the market, they become a full seller of the security. So I agree on your marginal ROIC theory there. I agree that you signal profit, but some strategies rely on.
Yeah. 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 Mm. Yeah. I mean, I agree that if you when it comes to a dividend, you say, look, I'm going to reduce the dividend because we want to take advantage of this large transaction. I mean, in my view, people are very skeptical of management teams. I mean, so when I hear management teams say that, I'm like, is this for real? Benefit of the doubt, maybe, but I'd rather actually just kind of, sell out. Yeah, I'd take my money and run. Unless they have a track record of essentially doing that year after year. Yeah, I think a lot of people. I remember hearing, like, I was chatting with one guy, and he used to say that when it comes to management teams, 1/3 good, 1/3 bad, 1/3 crook. So yeah, so he was very much of the view that management were yeah in their best interest first. So okay, and the dividend increase prospects are good, right? So I think that makes sense. Anybody that's increasing their dividends, we think that good prospects for the future. So okay, so I think that this is what Rob was talking about. So clientele effects, right? And agency issues about a company's dividend policy. So we can talk a little bit about here your client base. What does your client base effectively mean? So as you mentioned, you probably have a lot of pensioners in the UK, and because of that, a lot of them rely on that regular income. So different groups of stockholders or clientele have different preferences regarding dividend policies, right? So many pensioners or retired people might prefer cash payouts as opposed to higher earners who may not. So higher earning investors prepared to retain the earnings in the company rather than to pay out dividends. Okay, clientele effect. Let's see here. So company reinvests. Yeah. Okay. They talk here about it's called the marginal investor. So all they're looking to do here is they're looking to say, somebody that is going to be impacted by tax. What would they prefer? Would they prefer dividends or would they prefer capital gains? So we're just going to look at what it means in terms of, sell a share before it goes dividend, sell a share after it goes dividend, and then we just work out a little formula. I think it's fairly logical, so let's work through it together. Okay. So a company that buys a share, so PB, marginal tax rates on dividends and on capital gains. These are expressed as TD on dividends, TCG on capital gains. Okay. So if a company, before it goes ex-dividend, naturally then you're only looking at a capital gain because there's no dividend. So you sell the share. That's effectively your capital gain multiplied by your capital gain tax. Okay. So that effectively would be the value that you would receive to the extent you were selling it before the dividend. If you sell it after the dividend, naturally you're going to receive a dividend. So you're going to receive a dividend net of the tax, and then naturally there should be a little bit of a capital gain in there. So you'll receive your purchase price, your capital gain, and your net dividend. Okay, fairly logical, I think, right? So assuming that the marginal investor is indifferent about these two strategies, we can equate them to each other. So they must be equal to each other. And so all they do is they just make them equal to one another. And then they effectively put them into a little equation. They kind of chop and change such that they come out at a little equation. So I don't necessarily think that you need to study this equation. I think you can probably just equate it on a logical basis. So if there is a little bit of a question around this, yeah, I don't necessarily think that you need um, to really study this equation. I'm sure you guys probably have equations, you know, do you have a little cheat sheet next to your bed, like where the picture of your girlfriend used to be? So. So I think that this question is very simple. An investor pays taxes. They have a tax rate of 28 and 15%. What would they what would they prefer after taxes? So obviously $1 times by 1 minus our tax rate. Capital gain 1 minus our capital gains tax rate. And then you can see dividends, that would get 72 cents, and for capital gains, that would get 74 cents net of taxes. So based on this, obviously, you would want the capital gain. So I think that's fairly CFA level 1. So CFA level 2, we start to get into a little bit more detail. So they say that after the tax rate for all investors, capital gain is 20%. The dividend tax rate among investors is expected that the share price will drop by 70% of the dividend amount as the share trades ex-dividend. Okay, so here we can calculate the marginal tax rate on the dividend income for those who trade the share on ex-dividend. Okay, so we've got our little equation, and then all we do is we just input the variables. So let's do that. So do they give us a sorry, so they said, okay, so we'll go to 70% or so 70 cents. So that should be the 70%. And they said our capital gains rate was 20%. Is that right? So then if we just work that out, we should see marginal tax rate on the dividend income should be 44%. So yeah. Okay. And then the last one, I think that they just want to touch on. So we spoke about the clientele effect. So, and specifically, we spoke about somebody that's looking at taxes. So, at what point would they really be indifferent with respect to dividend income tax versus capital gains tax? And let's just touch on institutional investors. So, they only wish to invest in companies that pay a dividend or have a certain dividend yield. They therefore conclude that the clientele effect refers to the fact that companies will attract a set of investors who favor this dividend policy. So, yeah, back to our clientele effect. Okay, any questions around that? I think it's fairly logical. I think it makes sense, right? I mean, you try and, if you have a lot of retired people in your share, you may try and continue to keep up your dividends. So that's effectively the clientele effect. Okay, so agency issues. So I'm just going to run through this fairly quickly. We've spoken about this in the last one. Agency issues. Remember, managers and shareholders have different levels of information, right? Your managers are there as agents on behalf of the shareholders. Managers, if they start using that information for their own benefit ahead of the shareholders, that's when you start to get issues. Okay, so let's see here. So this refers to a conflict between managers and shareholders. Remember, I spoke about the Bush family. They owned Anheuser-Busch. They were sponsoring Shamu. I think, in fact, the baseball field actually in St. Louis was called the Bush Arena or something like that. Anyway, so lots of perks. So issues when a managers try and empire build. So remember, if you're empire building, you're investing in projects that may have a negative NPV, right? Remember our decision trees around capital budgeting. Negative NPV is destroying shareholder value. Okay, this would reduce shareholder value. So what they say here is that this actually paying out dividends is actually a great way to try and impose a little bit of discipline, right? So all the free cash flow must be paid out as dividends. So let's see. So they say here that mature companies would then be expected to pay out a large portion of their cash, so they should not be sitting on excess cash, right? So agency issues between bondholders and shareholders. What do you guys think? Do you think bondholders like dividends? Not necessarily, right? So effectively, money is going to the shareholders ahead of the bondholders, right? So I know that this has been, in fact, I think in Eqstra this was a big issue. So they were paying out dividends, and in fact they were not necessarily doing so well in terms of servicing their debt load. So shareholders may be inclined to pay themselves large dividends, which reduce the company's asset base and leave the bondholders exposed, right? Because effectively you're taking away cash, you're reducing equity. But just by that measure, your debt to equity ratio should actually increase, right? So you should become more levered. So naturally, you're going to have debt covenants, right? Debt covenants try and limit the amount of dividends that can be paid out. Okay. Any thoughts before we go on? Fairly okay, I think. Okay, so I think a lot of this is fairly logical. So explain things that impact on the dividend policy. Obviously, investment opportunities like Tondani, he doesn't want to pay out a dividend because he's got a massive opportunity coming to him. Some investors may, question that. So volatility of earnings in the market, to the extent that there's a lot of volatility. I think a lot of people, particularly in the financial crisis, they may just hold back a bit in terms of issuing dividends. I think you can make an argument for perhaps financial flexibility. So to the extent you want to retain cash, Warren Buffett, we spoke about fundamental options in the last class. He sits on a lot of cash. He thinks that there's a bit of optionality there, whereby he can effectively take advantage of opportunities quickly because he's sitting on the cash. Tax considerations. Yeah, so you don't want to pay out a dividend to the extent that you are having to now pay dividends tax. So I think we've spoken about that. Flotation costs. So when a company floats its shares, a certain portion of the proceeds is paid away as flotation costs. It's fine. We expect the cost of newly issued capital to be more expensive than retained earnings. This is because retained earnings. So generally, the higher the flotation cost, the lower the dividend payout, due to the need for the newly issued equity capital to be available for new investments. Sorry, let me just understand this. The higher the flotation costs, the lower the dividend payout, due to the need for this newly issued equity capital to be available for new investments. Okay, so I think what they're saying is that you don't necessarily want to pay out large dividends because if you do that and you have to go back to the market and raise equity financing, it's going to be quite costly. Yeah, so you'd rather actually just hold on to the money rather than pay it out. Because I mean, going to the market and raising new money would be expensive. Contractual and legal restrictions, so debt covenants, protect the bondholders, dictate what the company can and cannot pay out. Don't want to run through this too much. I assume a lot of you guys know about double taxation. So, if you'll pay a corporate tax rate, and then to the extent you pay out dividends, you may pay an additional tax rate. So, I think that also discourages many companies from paying out dividends. So, taxed at the corporate level, and then when a dividend is paid. So the effective tax rate is effectively the corporate tax rate plus 1 minus the corporate tax rate multiplied by the individual rate. Okay, so let's just quickly touch on a quick example here. Company that is taxed at 35%, dividend, the investor has a dividend withholding tax or a dividends tax of 15%. You can see that ultimately that would have an effective tax rate of 44.75%. Okay. Okay, so in a split rate system, they effectively say, earnings that come before tax, profits before tax, essentially those can be split. So, and they will be taxed at different rates. So, Earnings not paid out as dividends are taxed at perhaps a higher rate, and then to the extent you're paying them out as dividends, it may be taxed at a lower rate. Okay, so frankly, I've never actually seen this before, in real life, but it may exist. So an effective tax rate, same formula as above, but obviously the individual rate would be, or sorry, the corporate rate would be different. So let's see here. So they say that an investor's invested in a company is taxed at 35% of the corporate tax rate, and at 25% on distributed earnings. So obviously the distributed earnings would be what we're going to be multiplying by, and then 15% of dividends. So I think we're going to do something like where we say 25% multiplied by 1 minus our dividends tax rate, or sorry, our dividends tax rate, and 1 minus our distributed earnings tax rate. Okay, so let's see on the next page. Okay, so we've got our effective tax rate. There's the corporate tax rate of 25%, and then 1 minus 25% multiplied by 15%. So we have an effective tax rate of 36.25%. Okay, so then they also talk about an imputation tax system. Let's see, so earnings are taxed at the corporate level. Earnings are attributed to the shareholder and are therefore taxed at the shareholder rate. When submitting a tax return, you can deduct a portion of the taxes paid by the company from their taxes. In the event the shareholder is in the lower tax bracket, you will receive a tax credit on the balance between the two rates. Okay, so if we just look at the quick example, an investor is invested in a company that's taxed at 35%. Let's see, 100% is distributed. Assume earnings are 100 million. His marginal tax rate is 25. So you'll first pay tax on its earnings and then pay out a dividend. So the company will first pay tax on its dividends and then pay out a dividend. So they'll pay their corporate tax rate of 35%. So 100 million minus the taxes of 35. I think that's fairly logical. Okay, let's see. So assuming that the 100 was taxed in the hands of the shareholder, it would have been at a lesser rate. So that he would have received 75. So ultimately, based on the amount of taxes, he's able to receive a tax input credit of 10 million. So I was wondering if this is like our I'm trying to think about input credits in terms of our VAT system, but I'm not so sure. I don't the old? Oh, really? Okay. Okay.
But you never really refund all 10 million. For example, you wouldn't refund all 10 million not all.
So then what happens? Do you just receive a tax credit that you can net off in the future? Okay. Okay, so just a few other dividend policies. So I'm just going to run through these fairly quickly because I think a lot of it, I just don't want to stand up here and end up talking back to you, or reading back to you. So stable dividend policy, you want a fixed percentage of your retained earnings will be paid out by a dividend. So what you can do is you can look at long-term earnings before deciding on a dividend, and then all you're going to do is you're going to just adjust your so effectively you're going to forecast out for the next 5 years what you think your earnings are going to be, and you want to make sure that you have a stable dividend. So so you're going to have effectively this type of gradual movement. It's called the target payout ratio. So your expected dividend is going to be your previous dividend plus expected earnings increase multiplied by a target payout ratio, and then you're going to have this adjustment factor. So if you maybe say, look, we want to adjust our dividends over 5 years to effectively move in a certain direction towards a specific target payout ratio. Yeah, so let's look at the example. So a company paid a dividend last year of 1, so it'll come down there. We per share based on earnings of 5 per share. The current earnings are expected to be at 6 per share. The company's target payout ratio is 30%. So naturally we want to be at and is expected to bring its dividend up to this level over the course of the next 4 years, right? So let's see here. So So they got 6 based on the forecast earnings. They got 5 based on the current earnings. Sorry, based on the historic earnings of 5. The current earnings of 6. Target payout ratio should be 30%, and they're going to do this over the next 4 years. So if you just run the formula, so the expected dividend for the next year is 1.07. So I think all they're looking to do is they're saying, look, we want to achieve a certain payout ratio, and we want to gradually move our dividend there over the course of the next 4 years. Okay, so let's look at the next one. Constant dividend payout ratio. Yeah, so if you want to say, look, we're going to pay out 25% of our earnings. So no matter what our earnings are, we're always going to say 25 times by, say, 5, and that'll be our dividend payout. Obviously, there's a little bit more volatility in this kind of practice, right? So I think as your earnings moves around, share repurchases. And should there be a difference between dividends and share repurchases? Okay? What do you guys say at Deloitte? Do you encourage dividends? I remember being actually in a discussion actually with a big company, and they were saying, look, should we rather pay out the money as a dividend, or should we rather do a share repurchase? So do you guys express any house view on it? No?
This offers you less guidance to the market for going forward. They don't take
When you do a share repurchase?
yes. But I firmly believe that management in this instance, I've seen the evidence of
Yeah.
good capital allocations in terms of market.
Okay.
Because they can time the markets and they'll probably just grow the whole time.
Yeah, yeah. Yeah.
And you could also like you know, obviously that like management knows something the public doesn't, and they probably think the share was just sitting there and you just like a bit like undervalued right now.
So you're saying it's a good thing that they can actually time the market? Yeah. So is you saying that actually, look, that they have not been able to time the market?
I'm saying yes, they've got insider
Yeah. Information.
insights, but they make those insights based on their best estimates of a world that's like a non-linear constant change. And if you have a look at the amount, there's some managers out there that when you go to their investor days when they release their results, you go like for the past 4 years in a row,
Yeah.
for this should be from this and everything. So now if you want to buy shares back,
Yeah.
why am I going to believe that you're sending a signal now that you can't hit your targets?
Yeah. Didn't always just do like a share buyback for like 2 years ago?
I don't know. A lot of companies have been doing share buybacks, especially a lot of them have been actually raising debt. In fact, cheap debt, right? Because yields have been so low. So a lot of them have been leveraging up their balance sheets a little bit at low yields, and then essentially using that cash to buy back shares in the market. Yeah. So I think that a number of companies have been doing quite a lot of share buybacks. Yeah. Yeah. If there's cheap debt, you're saying they are a big culprit of doing it. Yeah. Yeah. Well, I mean, their yields are particularly low. Okay. Okay. So let's just let's run through share repurchases. So obviously different types of share repurchases. So open market purchases. So I think just the most basic, a company may just be sitting on a bit of cash and they may say to one of their brokers, please go into the market. Please go into the market and buy up shares in the market. Okay. So open market purchases. Okay. So you essentially just say, look, here's a line of cash. Whenever the share trades between this high and this low, just please start buying shares. Tender offer, they can make a fixed offer, usually at a slight premium to the current price, to encourage all shareholders to tender their shares or tender a portion of their shares. So shareholders may choose to either accept or reject the tender offer, right? So, yeah. Negotiation. Yeah. Oh, really? Okay. You're still not in? Yeah, that's what I'm a little bit nervous of. Thanks, Rob. Okay, so open market purchases, and then we can do a tender offer. So everybody equally from everyone. Um, and then we could look at things like negotiation. So specifically, if I've seen one or two companies that have done this. So we spoke in CFA level 1, we spoke about Coral Icon, big, aggressive activist investor. Many companies will go to him and say, look, I don't necessarily want you in my shareholder base. Let me buy out your 5%, right? So you can either do a direct negotiation, negotiate directly with one or two large shareholders. So I'll buy back your shares at a premium. So yeah. Compare the effect of a share repurchase to when a company is using cash compared to debt. Okay, so this is really going to come down to the yield that we're earning on our cash versus the interest that we're going to be paying on the debt that we need to borrow. Okay. Okay, so let's run through this example. It's fairly easy. We just got to follow the math. So if we buy back 100,000 shares, in the first instance with cash, in the second instance we're gonna borrow. So for our cash, we have an earnings yield of 5%, and here we have a cost of debt of 4%, right? So we have excess funds earned of 6%. So what's going to happen is the cost of the buyback will ultimately be the same, right? So that shouldn't necessarily change. We're going to be buying back 100,000 shares, and the shares are priced at 100. So naturally, it's going to cost us 10 million. Okay, so in the first instance where we have cash, we're going to have shares outstanding after the buyback is obviously going to be, is that right? So shares outstanding is 2 million. The cost of the buyback is, yes, we're buying back 100,000 shares, sorry. So we're going to go down to 1.9 million shares. The stock price will be at 100. Let's see, so the market cap should be at 190, and our earnings should be at 100 at 9.4. So let's just calculate our earnings here. So we're going to take 10 million of earnings, which we can see beforehand, minus the 10 million that we use, multiplied by the 6%. So the 6% was what we earned on our excess cash. So we can see that ultimately we would have 600,000 in terms of the money that we would not necessarily be earning on our cash, on our excess funds. And so let's see here. So our earnings would then be 9.4 million. So does everybody follow that? Is everybody okay? We started with 10 million in earnings. We're going to be minusing 600,000. That 600,000 is based on the cash that we held. And the cash, the earnings on the cash that we made, the interest on the cash. So the excess cash that we hold, we earn 6% on that. Okay. So, and it cost us 10 million of money to the cost of the buyback was 10 million. So 6% on our 10 million should have been 600,000, I believe. Everybody okay with that? Shane, all good? Cool.
We're going to be able to invest our cash at a higher rate and keep it liquid than the cash we're going to borrow and get at a low rate. Is that scenario quite likely? Okay, yes, if you buy bonds and you go long.
Yeah, so I agree with that. I mean, your cost of debt is typically higher than your cash. Yeah. So I tend to think that the CFA will give you these kind of numbers. I mean, they may give it to you in reverse, and they'll say, what happens to your earnings yield. So I think that's a common thing. So essentially, if you have an earnings yield here, like of 5%, but you are giving up cash, and your cash was earning you 6%, you should have a dilution in your earnings yield. So because essentially you're giving up an asset that was earning you 6%, and you're holding on to the rest of your business, which is only earning 5%. So I think that they would say, on that basis, what happens to your earnings yield? So that's the kind of questions that the CFA would ask, which I think is quite interesting. So you can see when you give up that 6%, and then on the flip side, when you use debt, your debt is costing you 4%. So to the extent you you borrow at 4% and you're putting it into your business such that you're buying back shares at 5%, you should have an earnings accretion, right? So you should go to 5.05%. So does everybody see that? Any thoughts? Okay, everybody okay with that, huh? Seeing like a couple looks around the room, people not so sure. Everybody okay? If you have any questions, let's chat at the break. Okay, so like they say here, so your loss from your interest earned on your excess funds, which was 6%, is greater than your current earnings yield of 5%. So then your new earnings yield should be slightly diluted at 4.95. Okay, and then obviously it's just the reverse, is the opposite will hold true for when you have debt. Okay, so that's looking at one share repurchase whereby we use cash in the one instance and then debt in the other instance. In fact, it doesn't matter whether it's actually cash or whether it's debt. It's effectively the interest that you are receiving or paying on your debt relative to your earnings yield. Okay, so let's look at the share repurchase on book value. So this is where we effectively are going to be buying something where we have a higher book value and then one where we have lesser book value. So let's look through this. So we're going to buy back 10 million again worth of shares. We have shares outstanding of 2 million as a start. Let's see. So we have a book value in company A of $50 or 50 rand per share, and in the second instance, it's going to be 150. So yeah, let's look through this. So in the first instance, you're going to be buying back number of shares is 100,000 because you've got 10 million and it's 100 per share. Finance with cash. Obviously, the book value after the buyback is going to be 90, right? Because ultimately, if your book value beforehand was 100 million and you took off cash of 10, 100 down to the 90, so it's 1 for 1 in terms of your book value, right? So in the other instance, sorry, let me put this in a different color. You started with a book value of 300, you went from 300 minus the 10, you're at 290, right? So so ultimately we had, in the one instance, we had a dilution in our book value, and in the other instance we had a appreciation in our book value. Okay, so you can see where what we need to be thinking about here is the stock price relative to the book value, right? So where the book value is actually higher per share than the share price trades at a discount to the book value, and yeah, and then we are using cash to essentially buy back shares at 100. Effectively, our book value per share should actually increase. So as we can see from the example above, book value per share will decrease if the share repurchase price is greater than the original book value per share, right? And then obviously the opposite holds true. So if you increase book value per share will increase if the original book value was at a discount, right? Everybody okay with that? Okay. Practice, huh? Your date for Saturday night. Okay. Book value per share on share repurchases. Okay, so let's run through this fairly quickly. I'm conscious of time. I don't want to be getting too close to 8 o'clock. So potential tax advantages, 5 reasons why a company would prefer repurchase. So I think that this goes to our discussion that we had there. Why would a company prefer repurchase as opposed to a dividend? If an executive is sitting with you and saying, look, I'm actually sitting on this cash, I'm sitting on 100 million, what do you guys think I should do? Should I actually issue it as a dividend, or should I rather do a share repurchase, right? So you can say to him, well, look, what is the most effective from a tax perspective, right? So in the event that capital gains are lower than dividends, then rather do a share repurchase, right? So if it's cheaper, capital gains is less than dividends. it is good from a signaling perspective. If you start buying up shares in the market, it may be considered um, a good um, a good signal to the market. You believe that your shares are underpriced. Flexibility. So naturally, if you're a manager and you're sitting on 100 million, instead of just putting all of that 100 million out in one shot, you can rather say, look, I'd rather just start buying up shares gradually in the market, right? So you can effectively, it's almost like drip feeding that money back into the market. Okay, so yeah, so it gives you a little bit more flexibility. I'm not sure about this one, offsetting dilution of employee stock options. Yeah, I mean, you buy the shares in the market to essentially issue them to your employees. So obviously, if I was an employee, I would love that. But and then, as we mentioned, increases financial leverage, right? So I think both dividends and share repurchases increase financial leverage, right? So yeah, so I'm not sure that that is also a difference between the two. So I think I don't necessarily want to run through this example, but ultimately, cash dividend, stock repurchase. So we've said ultimately you should arrive at the same answer, right? The value in the hands of the shareholders should be the same, right? So I think that's the conclusion that they ultimately come to. So as you can see down here, right? So the value in the hands of the shareholder is the same under both scenarios. Okay. Yep.
The first point, potential tax advantages.
Yeah.
This is from a shareholder perspective, not from
Yes. So we're always thinking about dividends or share repurchases from the actual ultimate shareholder, right? So
it seems like a lot of the other reasons are.
yeah, I agree. I think that's accurate. Like flexibility, yeah. So that's specific almost to the company, right? Yeah. So if you're sitting with a CEO but I mean, ultimately a CEO should benefit from having from the shareholders, yeah. So yeah, they should essentially be more favorable to the company, yeah. So, but I agree with what you're saying, yeah. So flexibility, that's the CEO who's saying that, right? Employee share options, that's the CEO that's saying that. Pardon? Signaling, yeah, exactly, yeah. Signaling is the CEO. So whereas tax advantages is, yeah, for the shareholders. I think this is what, yeah, this is a repeat. Yeah, okay. Trends in corporate dividend policies. I don't necessarily want to read that back to you. European companies pay dividends more than American companies. They say that over time, the number of companies paying dividends has actually decreased. I think it goes through stages, right? I mean, I think sometimes people want dividends and they do not trust management, so they say bird in the hand theory, give me my money. You know, maybe they trust management and they say, no, actually, look, you're doing a wonderful job. Just I'm irrelevant, or rather reinvest. Let's see here. So identify characteristics of companies that may not be able to sustain their cash dividend. Let's see some ratios based on dividends. So dividend payout ratio and our dividend coverage ratio, right? So yeah, dividend payout ratio, dividends over net income. So how much of your net income are you ultimately paying out? So depending on what kind of company you may be, some may target a certain payout ratio of, if you're a mature company, maybe 60%. Dividend coverage ratio is obviously just the flip side of that. Typically, you know, these form the basis of debt covenants, right? So let's see here. So free cash flow to equity metric measures the availability of free cash for distribution after flexible capital and fixed capital. So your capex and your working capital have been accounted for. And this is just a coverage ratio. So how many more times does your free cash flow sit over your your cash that's available for dividends and share repurchases, right? So obviously, if your coverage ratio should be greater than 1. You should not be, paying out dividends and doing share repurchases more than the actual free cash that's actually available to the shareholders in the first place. If it is less than 1, the company is needing to draw down on other reserves. So typically, it's needing to take on debt.
Just on this one, Paul, I put a thought here.
Okay.
Borrowings is included in free cash flow to equity, right?
No. The free cash flow to the firm includes borrowings.
Is it
This is free cash flow to
borrowing?
free cash flow to the equity holders. So this will essentially we will take off interest in this case. So we will deduct finance charges.
Interest, finance charges, yes, but net borrowing?
You have to add back net borrowings.
Net
Yes, sorry. So you're gonna add back. Yeah, 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 yeah. Is there net borrowings that goes into this? So because I thought that this was free cash flow to the equity holders. Yeah, but you shouldn't have. As an equity holder, instinctively, I'm thinking you should not be entitled to.
That's exactly what
Yeah,
I asked,
yeah.
because I think you'd add back net borrowings, but then what happens if you borrow to pay out?
Yeah, essentially, then you're leveraging up. Yeah, you're reallocating from money that should be for your debt providers. So essentially, you're taking from other sources of capital, right, to essentially pay to your equity holders. You're paying out more money than is ultimately available for them. Yeah. So
With that borrowing,
Yeah.
that ratio,
of course, yeah, you wouldn't be able to pay it out, right? In an unlevered company, you would not be able to pay that out. Yeah. Yeah. I need to just double check that free cash flow to equity formula. I haven't looked at it in a while. Yeah. But you may be right, and maybe net borrowings are on there. Do you? Impossible, man. I don't believe it. Yeah. Plus your net borrowings.
Is it not minus your interest plus your net borrowings? Because I think it's minus your interest with the tax, then you add on the net borrowings. Because if you're doing that, then you basically double counting that. Because the net borrowings will be sitting with a bit of the interest payment there. Could be wrong.
No, your net borrowing should just be capital based. I would assume, right? I assume that's what it's referring to. You need to just check the definition for net borrowings.
It's plus the interest rate. It's saying plus. It should be minus it there.
Yeah.
Minus the interest, then put it in the whole pool. Net borrowing. Is that right? Cash flow from operations minus.
Okay. Well, let's. I'll look at it at the break. Okay. Let's continue. Okay. So I don't necessarily want to run through each one of these, but ultimately you can see the dividend payout ratio, and then the dividend coverage ratio. So, right. So let's see here. So. Here, so they've got a bit of a formula here. So free cash flow from operations, so less capex, add net borrowing. Yeah. Yeah. So ultimately means let's see here. So you should always, I mean, to the extent you are below 1, like here, essentially you are taking funds like your free cash flow from operations. And yeah, you essentially you are failing to, you are moving money around. You are essentially having to take out more borrowings. Although I see here that the borrowings are much higher. I think let me look at this at the break. Interesting, they say here free cash flow to equity has declined over the past 3 years. This is the decline in net income over the same period. Was less than 1 in the first 2 years. This would indicate reduced liquidity and ability to cover, albeit that in year 3 the coverage increases to 1.5 upon further analysis. The increase is due to net borrowings and not due to increased profitability. So effectively just borrowing more and using that to pay out dividends. Okay. So they say here it's not sustainable. Okay, so let's, why don't we take a break there for 20 minutes, please? And then let's come back. We're going to touch on readings 24, 25, and then we're going to get into 26, M&A. Okay.